Okay, we're looking at one of the most profound geopolitical shifts in recent memory today, the 2026 U.S. naval blockade of the Strait of Hormuz. We are talking about a complete, top-to-bottom paradigm shift in global energy markets. If you're out there still trading this crisis using that traditional war spike playbook, honestly, you're playing a game that is completely dead. In this explainer, we're going to dig deep into the data and unpack what we call the Hormuz attrition hedge, just to show you exactly where the real structural alpha is hiding right now.
Let's kick things off with a pretty massive paradox, right? If the spot price of crude oil is spiking well over $100 a barrel, why in the world are so many retail oil investors actively bleeding capital? There is this huge, glaring gap right now between what the mainstream financial news is screaming at you, which is basically just buy oil, and the brutal, mechanical reality of how retail ETFs actually function during a prolonged blockade. Today, we're going to expose that gap for what it is.
So here's our geopolitical playbook for the explainer. 1. The attrition trading paradigm. 2. The 30-day storage countdown. 3. The tanker ton-mile multiplier. 4. Contango and the UCO trap. And 5. Beyond oil into true hedges. Let's get right into it.
Section 1. The attrition trading paradigm, from kinetic war to bottleneck logistics. Think back to when hostilities first broke out in February 2026. We saw your standard, traditional war spike in Brent crude futures, right? A surge of roughly $50 a barrel. But by April, a structural naval blockade fundamentally completely changed the environment. The old playbook tells you to just blindly buy crude and hold on. But the new institutional paradigm, attrition trading, focuses on the systematic strangulation of logistics. You don't buy the commodity anymore, you buy the bottleneck required to move it. To put this in perspective, the blockade basically bottled up about 12.4 million barrels per day in production. That is a staggering withdrawal of collateral from the global financial system. It creates what analysts call a liquidity gap in the euro-dollar market, which is essentially the offshore dollar-based banking system that keeps global trade moving. Because of this massive risk, war insurance premiums for ships didn't just tick up, they exploded. They spiked 40 times. A $40,000 premium instantly turned into a $1.2 million toll per voyage. That makes formal shipping practically uninsurable, which in turn forced the rise of dark swaps, these uninsured, under-the-radar trades using a ghost fleet of older, hidden vessels. And all of this? It effectively cements $100 oil as our new structural floor.
All right, moving to Section 2, the 30-day storage countdown, the geopolitical waiting room.
86 million. That number is absolutely inescapable when you look at the math of Iranian onshore oil storage. Look, with exports blocked, upstream oil production can't just be flipped off like a light switch without risking permanent geological damage to those reservoirs. The oil literally has to go somewhere, and Iran went into this crisis with 60% of that 86 million barrel capacity already full, so the clock is quite literally ticking.
But the real kicker here is the concentration risk. Fully 90% of Iranian crude exports flow through one single choke point, Karg Island. By April 2026, Karg Island's storage utilization was already hovering between 74 and 85%. And that specific threshold is incredibly dangerous. Once tanks push past 85% capacity, it's exactly like a major highway hitting rush hour. Operational efficiency just totally collapses, the internal distribution networks clog up, and the risk of contamination goes through the roof.
So, what does this actually look like? It builds into a highly predictable 30-day timeline. Days 1 through 10, we see initial, localized storage saturation. By day 20, aging ghost ships are frantically activated just to serve as floating storage. But remember, upstream oil has massive operational inertia. By day 30, they hit storage zero. This forces a total export equivalent shut-in. Pushing past this point risks catastrophic, completely irreversible damage to mature reservoirs. It is, no joke, a high-stakes game of physical engineering chicken.
Section 3. The tanker ton-mile multiplier, the real profit in ships sitting still.
Now, while everyone else is hyper-fixated on those missing barrels, the smart institutional money shifted straight to logistics. And the great irony here is that the real profit lies in forcing ships to take the longest route possible. When you have to reroute 20 million barrels a day all the way around the Cape of Good Hope, instead of just popping through the Suez Canal, you are adding 10 to 14 extra transit days per voyage. Think about the math on that. That detour effectively vaporizes a massive 33% of available capacity from the global tanker fleet.
33%. So even if overall global oil demand cools down a bit, the demand for tankers, it stays at absolute record highs because the ships are stuck on the water.
And you can brilliantly see this bottleneck alpha play out in the Baltic Dirty Tanker Index. Check this out. VLCC crude carriers heading to China spiked 315%. Incredible, right? But LR1 product tankers, the ones carrying refined products like diesel, moving from Jubail to Rotterdam, they surged an unbelievable 916%. Because refined products are an even tighter supply than raw crude, the premium for these clean tankers vastly outperformed the percentage gain in crude oil itself.
Section 4. Contango and the UCO Trap. The brutal truth of retail ETFs.
Look, to master attrition trading, you absolutely have to understand the futures curve. Right now, the market is in extreme backwardation, meaning immediate physical scarcity has spot prices way higher than futures. But the real play is the inevitable flip to contango. When Iran hits storage zero on day 30, the physical market is going to see localized price collapses while futures remain elevated. Contango simply means the future price of oil is higher than the current spot price. When that flip happens, holding physical storage turns into a literal risk-free profit arbitrage.
But here is the brutal truth. Retail investors see the scary news, they panic, and they buy triple-leveraged oil ETFs like the UCO fund. But here's the secret. UCO doesn't actually hold physical oil. It holds paper futures contracts. In a sideways, super volatile blockade, or especially when the market flips to contango, these funds are mechanically forced to roll their expiring front-month contracts into the next month. They are essentially trapped on a financial treadmill where they are forced to sell low and buy high every single month. That compounding loss, that's called volatility decay, and it will wreck your portfolio.
Seriously, the historical data on this is just staggering. Over a 10-year period, the spot price of WTI crude actually rose by 23%. But in that exact same time frame, the UCO ETF completely tanked by 93%, negative 93%. It completely destroys the retail assumption that you can just buy and hold these paper instruments during a prolonged geopolitical crisis. The specific instrument you choose to trade is just as critical as the geopolitical insight you start with.
So if physical storage is the play, where do you actually go? Well, some retail playbooks incorrectly tell you to buy standard Enlin self-storage REITs. Huge mistake. Those are struggling with a massive housing downturn and they're handing out 35% rent discounts just to survive. No, the real institutional alpha is in midstream Cushing infrastructure. We're talking about massive specialized underground salt caverns with 90 million barrels of capacity. They act as the ultimate structural shock absorber for the global market. Their operating costs are so incredibly low that they can easily sit back and capture that massive contango arbitrage.
And while retail is out there basically just guessing, professional desks survive these crazy volatility spirals using systematic portfolio neutralization. Here's how they do it. First, they assess their delta, which is just their aggregate directional exposure to the oil price. Second, they neutralize their gamma risk, which is essentially the momentum or rate of change by purchasing offsetting options. This ensures they aren't forced to buy high and sell low. Third, they dynamically rebalance. They are engineering positive convexity. In plain English, they set up the math so they systematically win, completely regardless of which way tomorrow's headlines pivot.
Section 5. Beyond Oil. True Hedges. The second-order ripple effects. All right, bringing it all together, this is your master geopolitical playbook. Institutions don't just sit on one position. They rotate their hedges dynamically based on that 30-day storage countdown. Days 0 to 5, sure, you play the initial war spike with Brent futures. But by day 15, as shipping freezes up, you pivot into tankers. By day 25, as upstream production curtails, you rotate into midstream storage. As storage hits absolute zero, you're playing that contango arbitrage. But the true, mind-bending second-order effect happens on day 36 and beyond, long agricultural commodities. Why agriculture, right? Because the Strait of Hormuz is not just about energy. It's actually the primary artery for the industrial inputs that sustain global crop yields. Between 25 and 33% of the entire world's seaborne fertilizer precursors transit right through this narrow little waterway. Right now, massive shipments of urea, ammonia, and sulfur are just stranded. And because of the biological lag of planting seasons, missing these deliveries projects a staggering 40 to 50% maize yield loss in Africa alone. This isn't just an energy crisis anymore, guys. It's a massive, delayed action, inflationary bomb that pretty much guarantees a multi-year food crisis by 2027. Which leads us to a really fascinating final thought. We've seen that rerouting around the Cape of Good Hope is fundamentally rewriting global logistics from the ground up. If the Strait of Hormuz is permanently rewired, and your traditional oil plays are completely compromised by instrument decay, are less crowded trades like wheat and copper actually the ultimate geopolitical alpha going forward? It really shifts your entire paradigm from energy straight over to agriculture and raw materials. I highly recommend taking a deep dive into the underlying data we covered today to map out your next move. Thanks so much for joining me on this explainer, and I'll catch you next time as we continue to decode the world's most complex systems.